Welcome everybody. In today's video we will talk about how to identify the best fair value gap where to enter a trade. I already found 3 different examples on the chart to show you how to identify the best fair value gap where to enter, because it's not always so obvious which fair value gap to choose to enter a trade. Okay, so let's start with the first trade example. In this case, the silver bullet hour start here. Previously, price took out this liquidity zone here to then break the structure to the upside. This already creates the characteristics of a good trade during the silver bullet hour. In one of my previous videos, I was talking about the checklist that I follow before entering a trade. When there is a liquidity grab which then leads to a break of the market structure, this increases the win rate of the trade. So how we can identify the best fair value gap where to enter the trade? First of all, we need to understand the market structure. In this case, market is completely bullish, so we search for buys. Once we identify the current direction of the market, we look for the most recent swing low and swing high, as I already marked here. Then we need to take the Fibonacci and we draw it from the swing low, in this case because we are in an uptrend, to the swing high. As levels, I use the 50%, the 61.8 and the 78.6. This for the retracement. In this case, I already marked the 50% level, which is the most important at this point. So I can already delete the Fibonacci. So here there is the 50%, which is also called the equilibrium. We have the discount area, which is below, and the premium area, which is above. The best fair value gaps to enter a buy are always below the 50% of the Fibonacci. Once price broke the market structure here, we had many fair value gaps where we could enter. Here there are 2, and then there was this one, which is the strongest. Why I wouldn't search a buy from these 2 fair value gaps here? Because they're above the 50% of the Fibonacci. What we need to wait in this case is a pullback into the fair value gap below the 50%. So you could enter here at the top of the fair value gap, stop loss below the previous swing low, a very easy winning trade. Now let's go to the second example. This is the second example. Again, we have a liquidity grab which leads to a break of structure to the upside, and the market structure is bullish again. So we look for buys. Here I already marked the 2 fair value gaps which was possible to notice after the break of structure. This was one which then got filled, and there was a fake move, a fake rejection of this fair value gap, 1 and 2 rejections, but then price dropped. The second fair value gap was here, and the 50%, it is exactly here, 50% of this swing low and this swing high. The fair value gap in this case, it is just above the 50%, but we have also an order block in the same point, and beside the fact that the stop loss here could be a little bigger, but we are aiming for a 1-to-1 risk reward or 1.5 even. So in this case 1-to-1 was more or less this liquidity area here, so this one was also a good trade. One of the most important things is to be patient, because you need to be patient for price to come into your area, because if you are not patient enough, you will end up losing the trade. Let's go to the final example, which was during the morning session, if I'm not wrong, because I was checking also if during the morning session you can find this type of setups. The silver bullet hour start at 10 a.m. with this candle. In this case we don't have a liquidity grab, but we have a break of structure, pretty strong. I can see price was ranging, took out the low, the high, and then price broke to the upside. So as I explained before, we marked the swing low, the swing high. The 50% is here, and in this case I was marking each of these fair value gaps. It didn't make sense to take the buy from these 3 fair value gaps because there was no way to put a safe stop loss, and the best fair value gap where to enter is exactly this one here, which then price mitigates and reject. And also we have this order block inside this fair value gap. With this trade example, I also found a second trade because I want to show you how to identify also some exit points based on the equilibrium level. In fact, here we have a strong fair value gap below a weaker one, which is this one. In this case, the entry was at the 50% of the fair value gap. Price went below the fair value gap, tapping into the order block, and then price started to rise until the 50% of this move. At this point, you made already enough profits to take out from the market. And also, if you wouldn't take the profit here, let's see what would happen. So from a winning trade, because probably you are aiming to target this high here, from a winning trade you end up losing it. For example, you could take profit in this point, let's say 70% of the position, you set the stop loss at break even, and here you got stopped out. but that's okay because you didn't lose a trade. This is the most important thing. Okay, so the video is finished. I hope you understood which is the better fair value gap to choose. You need to consider the level of the equilibrium. If price made a low and a high and we are going up, you need to consider that price will not go up forever. It will go down to then go up again. So you need to be patient to wait for price to come to you. Thanks for watching. Leave a like and a comment, and we will see in the next videos.